Good day. I hope you're doing well. Hey, Darren Catch here with Berkshire Hathaway Innovative. Wanted to drop off this video online and see if it might be something that opens a few doors or a few thought processes for you. One thing I'm going to cover here today is an analysis that I'll do when I'm either on the buy side or on the sell side to kind of give an idea of what's happening at different price points in different areas. It can be an entire city. Denver, Broomfield is going to be the example here, and it can be a specific zip or even neighborhood. This is going to be 80023 for my example. It's a neighborhood I used to build in, and they've got a lot of high-end, custom, and still new product that's being sold there. So it's quite diverse, quite high-end, and you're going to see by the stats what that actually means is in terms of days on market, percentage net of asking versus sold, and a couple of other details that we'll cover. I also do a great deal of analysis for investors. If you're interested, I can take a look at different products based on what your criteria is. And they don't have to be just here in the Denver metro area. As a matter of fact, a lot of the criteria that I'm seeing, or that I had been seeing, that we were using to pick up properties here in Denver has tightened up immensely. And now we're looking into outside areas. As a matter of fact, I'm looking at 4 different markets outside of Denver myself. So I'm going to go over that, how that looks in particular, as far as different ways that we can analyze the return on investment. Okay. All right. So this is, we're going to get started here just very quickly. I want to show you this. Now, this is what I call my market graph, and this is different price points or pricing bands in Broomfield and zip code again 80023. Now, I didn't analyze anything under $300,000 because in the last 6 months, nothing under $300,000 was sold. Nothing was listed, nothing was sold. Now that's how elevated this particular marketplace is. You'll see right now in this first price point of 300 to 400, there's only 1 active listing, 3 sold previously, no pending. That means nothing under contract. And they did have 1 expired in the last 6 months. Average days on market is 21,000. And you'll see that at this particular price point, they're getting more than asking. Up to 500, it's doing a little bit better. You got a little bit more inventory, etc. Excuse me, your list ratio is actually just a little bit softened, as you might expect. As the price goes up, it seems to be happening on every one of them. Strangely, this is strange to me at least, when you see these all sort of trending down on sold to list ratios, then you've got these ones right here that are hitting 100%, 103%. And digging a little bit deeper, I find that what's happening is that the list price is actually a base price that's set by a builder. And the prices are basically being elevated by options that are being added onto the house. So that's what's happening there. Again, in this zip code, you'll see that we seem to have a sweet spot between 600 and 650. This seems to be the predominant, or at least the lion's share of the market, although it's bridged either way on either side pretty strongly. So basically from 500 to 1 million. Again, a decent amount of product in the heart of that price. You'll notice that your days on market also start to increase. And as you get to 750 to 1.2, it sort of caps out, and then it drops back down here at greater than 1,250,000. And the reason for that seems to be is that, again, kind of like this, it seems like some of the builders are sort of manipulating the MLS and putting the details or the data in late. Basically, the house has been under contract for a while, but it finally goes into the MLS so it can track those stats, and it's throwing these particular numbers off. You'll notice, again, you've got like this little blip right here where it seems like a decent sweet spot. This is not all generated by builders and add-ons. There is just a solid price point right here between 750 and 1 million in 80023. Bah, spit that out. Strangely enough, we have more product in this zip code above 1.5 million than we do under 400. That is quite discerning, disturbing to me. It seems to be quite heavily slanted, although you'll see that these guys are sitting right here. So let's talk hypotheticals now. Let's say you've got a house that you wanted to sell, and we would go over these particular charts and an evaluation, of course, of what we thought your house was worth. And we'd even go out and take a look at what the neighboring competition looks like that's currently available, so we can get an idea, what's their shortcomings versus ours, etc., and what are our strengths, and how should we basically be priced in comparison to them. Well, even the best steps like that, the best intended steps like that, can sometimes be undone by an expectation that we're going to sell this house in a week, and the average is 131 days on the market if you're priced $1.5 million above. So I just wanted to, I like to throw that in front of my sellers, especially so they have an expectation of what's going to happen. And if I'm doing my job right, and if we're basically approaching it together lockstep, we're going to be able to beat this number and hopefully also beat this particular number as well as far as percentage sold to sold. So that's the first thing I wanted to cover. And if you've got an area, a neighborhood, or a house even that you're looking to sell and you want to know how it all stacks up, etc., and you want me to perform one of these market graphs, give me a call, 303-419-7568. Happy to dig into it and present it to you and show you exactly what's going on. We can go back 6 months. We can go back and do snapshots every 6 months for a certain period of time as well, so we can start seeing bigger trends. And this can be helpful if we're again, we're going to be studying something for perhaps a buy and hold on income property. So along the income property, I've got a project right now where I'm working with some people from out of state. We're going to be doing a 1031. If you've never done a 1031, it's basically you're taking a property that you're selling and you're rolling all of your net proceeds forward into another property. And these are real properties. Typically, again, I'm a real estate agent, so we're only dealing with land or homes or multi-tenant. But there are different rules that you can buy other bits of real property. You'd have to consult your tax attorney for that. What I'd like to point out on this one, though, is we've got a potential to do a nice high dollar one, and that seems to be where some of these high performers are still residing here in Denver. And this is a pretty good example. This one right here is the asking price right now of $1,250,000. In this particular example, the people would be rolling forward $475,000, taking out a note of $775 at a rate of 4 3/4, 30-year fixed rate. Now they would normally I'd be looking at like 20 or 15. And just sort of trying to basically carry itself and pay it off as quick as possible, because at my age I want something that I can have as an asset, and it's just basically paying for itself up until I'm ready to sell it or hand it off to one of my children. But in this case, they want cash flow. So this guy right here, with essentially the same sort of setup that they've got in the area where they're selling back east, and you'll see that our rental income, because this has got 4 different units and it sums up to almost $7,400 a month. There's also some additional details about that. But once you take into account your PI, your tax insurance, your maintenance, utilities, etc., and basically subtract all your total expenses, this is going to be what it flows, $2,100 approximately. Now, how does that actually stack up as far as ROI? Well, we're going to be cash flowing $26,000 a year. If our total outlay is $493, we're getting 5% off of that. Now, that's not the only thing that we're doing here. We're also getting these people who are renting to be paying our loan down. Every year, or at least the first year, the debt reduction is going to be almost $12,000. That's an additional 2.4%. Our tax savings, doing a straight line 27-year depreciation, is going to be $38,000. And if you are one who likes to take into account potential appreciation of the property, a lot of landholders or holders don't like to count on that. But if you're just counting on a standard 3%, which is what property tends to do over time, you'll see that it performs an additional 7%. So taking all of that into account, this particular property would give an ROI of about 15%. Not bad. A bit steep on the entry price, but not a bad performer. Again, if you've got a property that you're interested in looking at, let's say you've got something that somebody's proposed to you and wants to sell you basically directly, and you're thinking, hey, this might be a good rental property for me. Give me a call. We'll take a look at the numbers. I'm happy to break it down for you and do a presentation on pros and cons. And we can go over everything. All right, that's it. That's my basic spiel for the day. I hope you're having a good one, and I hope you make it a great day.